And when I say 60 to 70, all I mean is we're going to just blow out those silly old highs, because they really are silly. Because given the monetary degradation since 2011 or 1980, silver would probably be $200 to match the real buying power of silver at those peaks. That the recent breakout above the early year highs was false, meaning unsustainable. It was just another new high that didn't go anywhere. Gold will be advancing through the 3,500 and all the way up. You'll find that silver's gained just about as much as gold. It's been more irregular and there was a period there from those mid-2020 price surge where, gold got up over 2,000 and silver got up to 30 area.
Gold is quietly coiling for its next move, and the technical backdrop suggests it could be explosive. Futures opened Wednesday at $3,399.60 per ounce, up 1.5% from the prior day and nearly $911 higher year over year. A staggering plus 38.1% annual gain that's left most risk assets and even central bank forecasts in the dust. Michael Oliver, a veteran precious metals strategist and founder of Momentum Structural Analysis, sees this consolidation as a setup for a decisive upside breach. Even as the S&P 500 has rebounded, gold has remained resilient, holding firm in the upper $3,300 to $3,400 and repeatedly pressing against resistance. In Oliver's view, when the equity rally finally fails and its recent breakout proves false, gold will push through $3,500 and accelerate higher. Silver's technical picture is even more dramatic. Oliver projects a near-term run to $60 to $70 once the metal shatters its long-watched $50 ceiling, a move that would not mark a top, but the beginning of a revaluation phase. Adjusted for decades of monetary degradation since 1980 and 2011, he argues silver would need to reach roughly $200 to match the real purchasing power of its past peaks. The broader outlook into 2025 to 2030 remains strongly bullish, with silver expected to test its all-time highs as early as 2025 and break into uncharted territory between 2026 and 2027. Some analysts are more aggressive, eyeing $50 as the first waypoint on a much larger move. In this video, we explore Michael Oliver's technical outlook, covering gold's consolidation and breakout potential, silver's undervaluation and upside targets, the weakening dollar, the stagnant bond market, and broader commodity trends. Stay tuned, and if you appreciate in-depth, data-driven analysis of the financial system, be sure to follow for more weekly insights. Your support means a lot, and we hope you find this report both valuable and engaging.
Now, right now, the stock market is so frothy that I can't believe it. It is really frothy. And in fact, a lot of fundamental analysts out there, and I don't read this stuff in depth, but I know where they're coming from. Leadership is gone. In other words, you're down to very narrow leadership within the market that has driven it to a marginal new high. I say marginal, I mean, we're like 4 or 5% above the highs we saw late in 2024, early 2025. Most of the extreme the buying was in the just getting back there. Okay. Now, if you look at gold, a lot of people assume that if the stock market goes down and you guys are right, it's going to be a bear market, then gold's going to go down too, right? Well, historically, that's not true. There's so many examples. In fact, I'm going to put together a report today on that issue, going back in time. But if you go back and look at from February, I think it was, I wrote the date, February 19th, which is when I think the S&P made its top tick early this year, to April 21st, close to close now, daily close, dropped 16%. Yes, it was more than that intraday highs to intraday lows, but still, it was mid-February to April 21st. Drop hard. What did gold do during that time? Straight up, okay? It peaked, in fact, on April 21st. There was a peak, okay? It's the same day S&P made a low. So, okay, the inversion issue didn't work then. Okay, since then, the stock market has recovered. Therefore, well, if gold should go down, maybe if you believe that gold is opposite the S&P, which we do. Instead, it held steady. It's been 4 months now where you can draw a line through upper 3,300s, 3,400. It just goes up and down and up and down. You get the downswings and upswings. In fact, we get the 3,500 again, a few days ago, top tick again. So they keep selling it there at that big round number. But all this while, S&P went up. I'm going to bet you that when the S&P does start down again and prove even to the price chart guys, that the recent breakout above the early year highs was false, meaning unsustainable. It was just another new high that didn't go anywhere. Gold will be advancing through the 3,500 and all the way up. In fact, if you look within the gold complex, the monetary metal complex, and look at silver since mid-April, it's gone up. The gold miners, silver miners have gone up, even though gold has just held steady. So this fits with another scenario we have, and that is the asset flows in that area now favor the miners in silver. And therefore, we do think silver will see that zone this year, 60 to 70. And the gold miners have really asserted themselves in a way that surprises most people. Because usually it used to be, if gold has a down day, the miners get beat up pretty good. Now gold could have a down day and they're up. You know, it's surprising to most, not to us. I think that's an indication, especially in the mining sector, that there is money beginning to flow out of the stock market that is it is doubtful money, meaning they doubt the sustainability of what they're seeing on the tape. And therefore, they're moving into other assets. And they finally realize that actually the gold miners, you know, they're at a better level now than they've been for 10 years versus the S&P. They've been, in other words, 10 years ago, they're beating the S&P. If you just bought and hold the gold miners, nobody knows that. You know, they don't mention that on Fox Business or CNBC about how gold, silver, and the miners are outperforming the S&P 500. Well, if you do all the performance graphs you want to of this asset category and that, you'll see T-bonds haven't been doing well. They're usually an alternative to the stock market. Not much is doing well, except gold persistently has been doing well. And more money will flow. Look at a chart of Newmont, for example. Pardon me for getting long-winded here. Newmont has both outperformed vastly and underperformed vastly gold price over the years and the mining sector. It's the big blue chip. It's the one that if you're a major asset manager and you're going to buy into the gold stock arena, you're probably going to include Newmont. Why? Because it's the big blue chip. You're not going to go out and buy juniors or something. It has exploded this year. It's up like 85%. You know, what's the S&P up? You know, 10, 15 from the year with the close of last year. So there's no comparison. Money is flowing into that for some reason. And a lot of that explosion in Newmont has occurred while gold's been going sideways. So think about that. Somebody's buying the gold miners. Why? It's not because they're all frothy about gold over the last 4 months. It's because they're moving money somewhere to somewhere. I think as you break the stock market, that money flow will become massive.
Michael Oliver identifies $39 as a critical pivot level in silver, where persistent selling pressure has repeatedly emerged, likely due to its proximity to the psychologically significant $40 mark. He notes that short sellers seem willing to risk a dime by positioning just below this threshold, yet recent price action shows their efforts have failed to trigger meaningful downside. A brief pullback to $37.50 was quickly reversed, with September silver now hovering near $38.50, evidence, Oliver argues, of a market that has yet to experience a true sell-off. With silver already up over 33% year-to-date, he views the current consolidation as a sign of underlying strength rather than weakness. Oliver also underscores the importance of monitoring cross-market dynamics, as broader forces are increasingly aligning in favor of precious metals. Chief among these is the US dollar index, which he believes has entered a significant bear market after breaking below 104 earlier this year and currently trading around 98. Technically, a decisive break beneath 97.60 to 97.90 could open the door to a test of the July lows near 96.37, with 97.00 as an interim target. Resistance remains at 98.95. And Oliver cautions that a sustained move above 100.00 to 100.15 could invalidate the bearish setup. Until then, he sees continued dollar weakness as a supportive tailwind for gold and silver. Let's get back to the interview.
Yeah, it's congestive for the last 4 weeks, let's say. 39 has been a level that the ever bears keep selling, you know, probably because it's in front of a big round number called 40, you know. So, hey, let's risk a dime, you know. And so far they're getting a lot of selling done, but not much price sustainability on the downside. It has spiked down to 37.50 right now. The SEP silver's trading 38.50, you know, and that was earlier this week or last week at the 37.50. So there's no real sell-off in silver, just a pause, okay? If you go back, you know, 4, 5, 6 years, you'll find that silver's gained just about as much as gold. It's been more irregular and there was a period there from those mid-2020 price surge where, gold got up over 2,000 and silver got up to 30 area. That gold went sideways during that next several years, 2021, 22, 23, and into early 24. And silver and the gold and silver miners had a staircasing pullback, overlapping, go down, go up, but net on balance, a pullback. So they underperformed. Technically speaking, when we assess that spread relationship between silver and the miners and gold, they've broken out. In other words, they've said to us, that relative performance, underperformance trend is over. They're now outperforming again. And sure enough, look what's happened, over the last couple of months, especially since April. Silver's gone up from, a high in, you go back a year ago, in May 24, we had a surge high at 32.70. And then since gold's gone sideways since April, silver's gained, about 10, 15%. Why shouldn't silver be? I think it's just a grand mistake. Markets make mistakes. They remain underpriced for too long because of sentiment, etc. And then when they say, oops, I made a mistake, you get ballistic moves. And I think that's what we're seeing. We see it technically happening. And when I say 60 to 70, all I mean is we're going to just blow out those silly old highs, because they really are silly. Because given the monetary degradation since 2011 or 1980, silver would probably be $200 to match the real buying power of silver at those peaks. And ultimately, that's probably where it's going. I'm just talking about this surge. And I think that because of folks are so silly focused on 50 and 50, that a lot of people are going to think that's technically important to take it out. And they're finally going to wake up when silver does blow through that silly price level. And then you're going to have the public say, well, golly, all-time new highs in silver. Why wasn't I there? In fact, in real dollar terms, it's still undervalued taking out those highs. But I think that you're going to gush through that, run all the stops, so to speak, suck in new money that hasn't been in at the appropriate places, and won't level off and pause until you get up to about 60 or 70. We've got a few technical reasons for that. But that's not the top. I'm just talking about this surge, meaning between now and year end. We're arguing this particular wake-up phase in silver, where it finally does what copper's already done, take out the 2011 high, what gold has amply done, taking out its prior major peaks. Silver's going to rush those old highs. It's been a major technical and fundamental mistake for it not to have already done so, along with copper, for example, and gold. And on a monetary basis, in real dollar terms, if you undegrade the price of silver and put it in line with where the degraded dollar really is now versus where it was in 1980 or 2011 peak in silver, would probably be $200 an ounce just to match those highs in real spendable dollar terms. In other words, to compensate for the monetary degradation. But we're just talking technically about this particular surge because we think those two highs, we call them idiot highs. Frankly, because they are stupid, because they're so many decades ago that they're next to meaningless in real value terms. But everybody is aware of the two peaks at 50. And so when every investor out there is aware of it, that's the point where they'll finally wake up and get a smack in the face and say, gee, why wasn't I already there? And that's when they'll get interested, and you'll no doubt get some gushing buying on the other side of 50. You're not going up to 50 and stop again, okay? You'll blow it out. And when you do, you're going to get a gush of buying, and it'll probably at least take you another $20 or so. And again, there's minor technical reasons for that. It's not a long-term top. We think silver ultimately may go to like $200 an ounce over the following year. There are other factors in play here that will facilitate or stimulate that further move in gold and silver. And that is the breakdown in the stock market, which always then is followed by massive breakdown in the data points. Employment numbers go bad really, really fast. Factory output, all the numbers that the Fed likes to look at and use as their academic excuse, they'll have. And in which case, and plus we have a president who wants to print. Okay. So, he wants a Fed chair that will do the same. So we know that's going to happen. In fact, it's going to happen before Powell leaves because he'll have enough evidence, and already he's got enough objections from members of the Fed board to have to pay attention. It was 2, now it's 3 and 4 saying, yeah, we need to cut. Okay. So it's going to happen. And that means that the Fed, again, will put their pedal further on the floor, put their foot onto the pedal, and you'll have monetary excess in all kinds of different ways. You'll see it in the M2, you'll see it in Fed on the rate cuts, and also see in their buying their balance sheet, because there will be emergencies out there. And we're looking at certain areas in the stock market that most people aren't. Most people look at NVIDIA and Microsoft, and I'd pay real close attention to them right now, especially where they close this week out. We've got some numbers that are being, especially on Microsoft, that are being threatened right now. We get a couple days left in the week, but you break them, all of a sudden, one of the two remaining leaders of the Mag 7 will start to go down sharply. And that's going to surprise people and probably help take the market down, because in that last break we just had in the S&P a few weeks ago, Microsoft and NVIDIA did not break the same metrics that we saw broken in the S&P and NASDAQ. But it's very important not just to put your eyes on gold and say, what's gold doing, okay, or what's silver doing? Look at these other markets, even if you're not in them, because they will impact gold and silver either positively or negatively. And right now we see the forces shaping up in a way that are positive for gold. For example, I think the dollar index has already entered a bear market, significant one. We got bearish above 104. Right now it's trading around 98. This is back at late March.
The current market backdrop is not just favorable for precious metals. It is structurally built for their outperformance. Equity leadership has narrowed to a fragile few names, bonds have lost their defensive appeal, and the dollar's weakening trend has removed a significant headwind. In this vacuum, capital is gravitating toward the only assets that still carry both liquidity and trust: monetary metals. Gold's resilience near resistance and miners' early outperformance signal quiet accumulation before the broader market reacts. Silver's setup is even stronger. In real purchasing power terms, it remains deeply undervalued at levels tied to past periods of explosive growth. A decisive breakout above long-standing highs could trigger a wholesale repricing, attracting capital from sectors unprepared for the rotation. With the rising probability of renewed monetary easing and the risk of equity market breakdowns, conditions are aligning for a significant shift in the market. This is not about chasing price, but recognizing the turn before it becomes consensus. Once the reallocation accelerates, the move into gold, silver, and miners could be swift, decisive, and historically significant. If you find this breakdown valuable, please like the video, subscribe, and share it with other serious investors who need to hear this. We'll continue to bring you the brightest minds in the markets and the insights to stay ahead of the storm. Thanks for watching.